In this video, we're going to be looking at the concept of moving averages. And some of the objectives we're discussing include the different types of moving averages and how some of these are calculated, moving averages acting as barriers to price, moving average crossover signals, and the final objective looks at some ideal market conditions for moving average analysis. The first moving average that we're going to be looking at is called an SMA, a simple moving average. It's essentially an arithmetic mean of closing prices. Now, what does this mean? If you've got 10 bits of data and each data point accounts for a numerical value, and you're trying to calculate the arithmetic mean of it, you add these 10 data points together, you get your sum. Your sum is divided by the amount of data points, which essentially is just calculating an average of something. So in this case, your SMA, your simple moving average, would just be calculated by that arithmetic mean. Now, by using a simple moving average, you can smooth some price action. What do I mean by this? Look at this graph. We've got the shares of Netflix, as we can show here. Each candlestick represents a day, and we're using a 10-day simple moving average. So as you can see, 10 data points in, each point on this line is the average of the recent 10 data points up until the last closed period. So, as can be seen in the chart, the moving averages show the general trend, and that is without the shorter term oscillations, otherwise known as noise, market noise. A lot of the times people struggle to find trends, but in this case, as you can see here, let's just make it a little clearer, by using this line, this simple moving average, we're able to understand that in the first part of the graph, the shares were trending up. The second part, if we could cut it into thirds, for example, the second part had a little bit of choppy sideways movement, but the third part, the shares broke below this simple moving average, and you had an established downtrend in the shares from around $360 a share to roughly $300, should we say, instead of bucks, to make it more formal. And if you use a longer look back period, you'll have a smoother appearance of the graph, and you'll see a lag further behind price. The next type of moving average that we're going to be looking at is called a WMA, a linearly weighted moving average. It essentially attributes more weight to recent price data, and the formula to calculate this with a period of n is essentially calculated by using the most recent price, which we'll get here, multiplied by n plus the previous price. So if a data set is used here, we've got the 5 most recent points, but we're only using a period of 4. Let's say the most recent price is used here, 106 times n being 4. In the next point, 104 times n minus 1, so 104 times 3. And then the next bit, 102, next most recent price, times n minus 2, so you times that by 2, and so on. You'd simply do that, and you would divide it by this formula, n plus n minus 1 plus n minus 2, to the point where you get to 0. Now your total sum in this case, how does that work? We've got a period of 4. And we know that the most recent price point, as per using this formula, for the denominator would give us the 4 plus the 3, because we're minusing 1, and then plus the 2, and then plus the 1. And we're not using more than 4 bits of data. 4 is our period figure, so we will simply stop there. So by adding the summations together, we'll get the summation of the weights, the attributed weights to the recent price data, as we can see here, more weights on this bit and less on the furthest bit away. We will get a sum of 1,040. And we'll simply divide this by the sum of the weighting factors, 4 plus 3 plus 2 plus 1. So by getting 1,040, dividing that by 10, you get 104. So that is how you would calculate the WMA, the linearly weighted moving average. Now, looking at EMAs, exponential moving averages, they're quite similar to the WMAs, the weighted moving averages, in a way that the EMAs give more weight to recent prices. But unlike the WMA, it uses an exponential weighting factor. This essentially means that all the data is incorporated since the inception of the average. In the previous slide, the fifth price was ignored in the calculation, and that was because it was outside of the lookback period. We had a period of 4. We were only looking at the 4 most recent bits of data. Now, the EMA doesn't have a lookback period in that sense. No data gets ignored, and it is all incorporated in the calculation. Each new EMA value uses the previous EMA value in its calculation. So, we have a diagram here. The result is a moving average that is more responsive than the SMA. If we look at the chart here, we can see that both the moving averages have the same period. We've got 50 for simple moving average and 50 for the exponential moving average. But the EMA, as shown in green, is more responsive to changes in the price than the SMA, which is shown in red, as we can see. When the price changes quickly, the EMA moves faster to catch up and adjust the price levels. Look closely at this point. Let's move the mouse to show this green line. This is the EMA. You can see it acts as a level of support with more clarity than the red line, which is the simple moving average. Why? Because it uses an exponential weighting factor. This very weighting factor is the reason why we're able to get a realistic understanding of where the price is at in terms of its trend. So how do we exactly calculate an exponential moving average? Well, by using the formula here, the EMA equals the latest close multiplied by the weighting factor. The latest close multiplied by the weighting factor plus the previous EMA times by 1 minus the weighting factor. We must remember that the weighting factor is a figure that's chosen by you, the analyst, or the trader, whoever is using this tool, and it is added to the previous EMA multiplied by 1 minus the weighting factor. That may look a little complicated, but we'll give an example here. The weighting factor isn't that important because, as I mentioned in other videos, the weighting factor is normally referred to as the input. When you're using charting packages, they won't ask for a weighting factor when you're setting up your EMA. Instead, they ask for a period. This is not the same as the lookback period used in truncated moving averages, but to find the EMA period you want, you'll simply use a formula below. But before we look at that formula, we'll use this. Your EMA with a weighting factor of 5% equals the latest close times by 0.05 plus the previous EMA times by 0.95. So try using some data yourself if you're interested. If you don't know how to use this formula with the weighting factor, you can calculate the EMA period from using your weighting factor. So 2 divided by the weighting factor, so in this case 5%, 0.05, minus 1 will give you your period, and that is 39. If we've got it here, that's exactly what you're looking for. Putting the theory aside, we've got an example on this graph of the Netflix share price, and this example is used with a 39 period EMA, or otherwise an EMA with a 5% weighting factor. So let's have a look. Let's have a quick look here. From the beginning of this chart, we can see that this 39 period EMA is used as a level of support in a short-term uptrend. We can see that the shares are holding above. Netflix shares, each candle here represents a day. We can see that the shares are closing above this level or teetering around it but not breaking down, holding that front. That seems to be a strong area of support for trend traders, those that maybe sell when they think that they have enough profits and they think the trend might reverse, and then when the primary trend is intact, in this case this is a longer term uptrend, as we can see it's held from November 2019 to around March 2020. This is relatively long term. I mean, a couple of months helps. Medium term, should we say, to be honest. That could be more appropriate. the shares have been holding above this level. You'd be buying on the points of support at this line. If you were a bull and you had the conviction in the share, you thought the company was financially sound, essentially that would be where you're buying. And we can see that this level is held once again. It had held for a fourth time momentarily, but the shares failed to hold above this level, broke down, and the trend reversed. The shares went from a medium-term uptrend, should we say, to a medium-term downtrend, assuming they didn't bounce back, which they actually did. But if we took COVID-19 out of the picture, the technicals looked quite ugly for the shares. The next moving average we're going to be looking at is called a VWMA. That's a volume-weighted moving average. Now, a volume-weighted moving average factors in the commitment of investors by weighting prices according to volume. It has a look-back period just like the SMA or the WMA. It is calculated simply by calculating, or multiplying rather, each price by the volume that accompanied it. Then those volume-weighted prices are added up and divided by the total volume for the period. And they're very sensitive to bars with very high volume, should we say. We'll give an example here. Now we can see that the shares of Netflix, once again, we've got a daily chart. Each candle represents a day's worth of trading. Now we can see that when the volume spiked here, if we've highlighted here in yellow, the volume spiked, the shares gapped up on open, and the volume weighted moving average adjusted much more quickly in comparison to the simple moving average shown in blue. The VWMA is in red here, and it adjusts quickly to the higher amount of volume, the events. This could be an earnings call, this could be all sorts of things. This could be some media speculation of whatever that could be happening. That leads to a point where the VWMA adjusts much more quicker than anything else would. We're going to also have a look at moving averages as price barriers. The first way to use these moving averages is to look at them as a barrier to price. That essentially means that the price can find support and resistance, or support or resistance, at a particular moving average and reverse from it. In this example, the price tests and reverses from a 50-period SMA on a number of occasions, including very recently. So looking at this chart, this is the chart of the British pound against the US dollar. It's a currency pair. We can see there was resistance at this point. The shares broke above the 50 simple moving average. This was a barrier. The price broke out for the currency pair, and we can see a rally, a consolidation of an area of support here. Prices break out, tries to test support, fails, but that is an important indicator. You've got 3 important levels that can help you in your trading. Let's look at another one. A false signal. This is more so an area of resistance. The shares broke above. That's probably a false signal. There's another potential false signal. But in this case, if you went short on the break and held with a stop a little bit above this 50 simple moving average, then you would make a decent amount of money in terms of your returns on this short trade. But the problem is that would be from 2015 to 2017. So you'd be holding for quite a while. But this helps gauge an understanding of the trend nevertheless. Even in 2020, let's look. There was a bit of resistance here at the 1.3 area, $1.3 per pound. And we can see that the price of the asset couldn't break above this area and fell right back down. You could have shorted on a test of this level if you had some bearish sentiment, some conviction behind a fundamental idea or whatever. In terms of risk management, you would be able to manage this position and create some value for yourself by going short on the test of this 50-month moving average in a simple sense. We've got another example from hourly oil prices, meaning each candlestick represents an hour of trading data. A 200-period simple moving average is used as resistance throughout the downtrend, and it turns into support during the uptrend. So we can see this area is a bit of resistance, and we can see that it's another bit of resistance here. We've got this as resistance, and the price of the WTI crude oil contracts actually break out above this area of resistance, an important area, the 200 simple moving average on the hourly, and that seems to be an area of support when the price reverses. And again, these signals could be great for if you had the conviction to go long or short, in this case shorting these tests of resistance and going long on the breaks of the resistance and going long on tests of support if you had an underlying bullish bias. So you can see going long, let's say long here and long again and long again, 3 sets of starter positions and eventually catching the big one. That would be a great way to generate value by simply using these moving averages. So you can also get signals from moving average / price crossovers. When a price crosses above a moving average, a bullish signal is issued. Well, a bullish signal can be found, and that occurs when price crosses back below. You'll have the converse, which is a bearish signal. So here's an example of a 55 period EMA giving a good buy and also a good sell signal with price crossovers. So in this case, we've got a good buy signal here with the crossover. Price crosses over the exponential moving average. We've got the price crossing under the exponential moving average for a sell side trade you could be shorting if we go back there quickly. And then you've got here your buying, your long side technical signal. You're able to go long on the break. The price crosses over this moving average. This is normally a bullish sign, and as seen throughout the remainder of the price data, that actually was quite a bullish sign. You can also get signals when 2 moving averages of different periods and possibly different types cross over. Shorter moving averages crossing over a longer one is quite bullish. When a short-term moving average crosses below rather, is quite bearish. Let's give an example with the graph we have here of the Dow Jones Industrial Index. The first green arrow is a simple bullish signal. Why? Because you've seen the shorter term moving average cross over the longer term moving average. That is a bullish signal. It's lagging in that the signal comes way after the price has turned, but it's still a sign that the trend has changed into an uptrend. Now the next 2 signals are a little bit more significant. The first red arrow is a bearish signal. This is way more significant than the first signal because not only do we have the bearish crossover, but we also have the price testing both moving averages at the point of intersection. This makes an extremely strong barrier to the price where there's a very good chance that the price will reverse strongly, and as we see here, it does. The price falls to a significant level. And then we'll look here at the second green arrow. This is the last crossover signal. It's also very significant for the same reason we mentioned before. Again, we have the signal from the crossover. This time though, it's bullish. But at the same time, the price has pulled back to test both moving averages at the point of intersection. This is quite a coincidence because I've noticed that the shorter and the longer term support are being tested at the same time as the bullish crossover, and again the price responds strongly. If we see here, the shorter term moving average breaks out and the longer term moving average is trending down. This area seems to be a level that is tested for both positions. This Dow Jones Industrial Average Index pricing tests both levels of support and rebounds straight off there, which is an interestingly bullish sign. Now, a confusing area for many people using technical analysis and moving averages within their strategies is the problem of choosing a look-back period. Well, I would suggest actually testing to see what periods yield the best results. This is especially relevant if you're using a specific strategy based on moving averages that can be tested. You can also use common look-back periods. And by doing so, you can see the signals that a lot of other market participants will be looking at. A common look-back period, as we've got here, you can use a 20 period, you can use a 50 period or 100 or 200. For another example, using two moving averages from numbers from the Fibonacci or Lucas number sequences could be important. Say we use those two moving averages and we use periods of 55 and 89. Those are consecutive Fibonacci numbers. We could backtest these on a spreadsheet, simply manually doing them or code one, and then try, or maybe by using an algorithm in the easiest way, you would be able to understand which ones have the highest hit rates in terms of real bull signals, real potential trades. You can use historical data, but the problem is past data does not specifically guarantee future returns. This is the old saying that goes, and it is extremely important to remember when relying on such signals. The problem is moving averages are not effective in choppy sideways markets. They produce way too many false signals and whipsaw, which essentially means that they cross over all the time with each other and the price. We've got a choppy chart that we could include here that gives absolutely rubbish signals from moving average crossovers. There are way too many signals given in that consolidation point that we've got here in yellow. You've got way too many false signals. Price breaks down, break out, breaks down, breaks out, breaks down. You'd probably lose in many trades consecutively by trying to guess the trend here. It would be safer to wait until there's a clear established trend, which we could see maybe here, a little bit of an uptrend there. That would be easier to trade. Crossover here, maybe trade. I don't know. But you need to wait for a clearer signal. There are way too many signals that are given in this bit that are completely rubbish, and a lot of charts, especially in current market situations like right now, 2020 April, 2020 May, you've got a lot of choppy market signals, and you should sometimes wait. It's better to be patient before you get some clarity and then continue trading. We've got a final example. This final example is a daily chart where we're looking at gold prices, the daily gold prices. Remember, each candle here represents a day of trading data for gold prices. So we've used two simple moving averages with periods of 21 and 55. We've got a couple of points here that we can look at. The first red arrow here, let's have a look, is a great sell signal. And that's because the market is trending. Then there's a good buy signal next. Let's find one here. Because there's a bullish crossover and the moving averages here are used as support. One interesting point to see is that the shorter term moving average, the red line, is tested, and then the longer term moving average is also tested. It's interesting to see that the shorter moving average contains the prices, but the longer one contained the actual low that was recorded. And that was the low of the candlestick wick that you can see right at the bottom here, as shown by this green arrow and me hovering around it with a highlight tool. So then the moving averages become less useful during a choppy sideways set of movements, and it starts whipsawing. Look at the price here. You can't see clarity. You'd probably get stopped out trying to catch the trend reverse, and you'd probably lose quite a bit of money. The price crosses above and below the moving averages too much. The MAs cross each other, generating too many bad signals. Essentially, the consolidation persists until the final green arrow, which is beyond here. And that's where we get a very strong signal. Again, when the price tests both moving averages at the point of intersection, whilst forming a bullish crossover, we can see. Let's highlight it one more time. The shorter term moving average crosses over. This is a bullish sign. We can see the market begins to trend, breaks out of this choppy consolidation, and then we would simply go long on these levels, bullish signal. Surprisingly, this works well. We've used some interesting numbers, I believe, both Fibonacci numbers, 21 and 55. That final green arrow we've mentioned again shows this point where, once again, you would go long. A bullish signal has been made, and that signal is strong enough to catapult price higher and break out of that consolidation once and for all. So, in conclusion, Whilst moving averages can give you very valuable insights into market trends, how they interact with each other can also give extremely significant information, especially when they decide to coincide and make a strong point of support or resistance. But be warned that you should consider market conditions before looking at moving averages, because they're more effective in trending markets than consolidating markets. Its power can be very huge, to the point to combine moving averages with other technical tools. But one popular tool to use in conjunction with moving average or moving averages is the MACD indicator, this oscillator. So consider watching our video on the MACD, which goes through how to interpret it in some depth.